Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to CEO Ian Strafford-Taylor and CFO Richard Cooper of EQLS Group, a leading international e-payments and fintech platform. So welcome, gents.
Yeah. Hi, Paul. Good to see you.
Yeah, well, massive congrats on this morning's frankly stellar first half results and inline guidance. In fact, as an analyst and as a investor, I have not seen a finer set of first half numbers across the hundreds of stocks that I cover. So a really big pat on the back there. Ian, perhaps we can start on what's been sort of driving that terrific top and bottom line performance.
It's a short question, but lots of answers to that. I mean, as we've seen last year and the trading update we gave in July, the growth is broad-based. So the core or legacy business, whatever you want to call it, is doing well. And then we've overlaid solutions on top of that. And of course, in H1 last year, there was practically zero from solutions. In H1 this year, there was like 6 million. So that gives you some of the delta, but not all of it. And we've had travel come back. So, we're running 75, 80%, maybe even more of the sort of revenue levels that we were back in 19 before COVID hit. But that's sort of icing on the cake as well. So everything's firing. Really, really well. And I think not only was H1 fantastic, and, we'd kind of put the revenue number in the market anyway because of the trading update. But I'm really, really positive about what we've managed to do in July, August, and the first few days of September, as you can see from the trading statement or update that we gave just now. In that, I get asked a lot, well, how's the business going to react to this or that or the other or inflation? And it's really hard to know because there's so many variables involved there. And really, the only way to know is to see what actually happens. And, our trajectory remains fantastic, or has done so far. Clearly, we're cautious, and I think it's the right way to be. Based on the numbers we've just produced, the outlook looks good, but let's just get another month or two under our belt before we really know where we expect to be at the end of the year. But we're performing super well. I think the last bit to mention is that the improvement below the revenue line, is some of those operational gearing things coming through. The cost base doesn't have to go up as fast as revenue. So we're starting to get that critical mass. All these good things that we talked about that would come are now coming. So you're seeing a combination of all of that into this trading statement and first half results. By the way, thank you for your fulsome praise about it being a good set of numbers. We're very proud.
I bet you are. Now, Richard, your finance team seems to be knocking the ball out of the park as well, because I just noticed on a year-on-year basis, if you look at the sort of the sequential of the contribution, which is gross margin less the marketing costs, you've pushed to sort of like on a year-on-year about 4 million into your contribution, and nearly all of that, in fact, just about more than that, has dropped through to the EBITDA line and to the cash line. So you're clearly getting a lot of operating leverage there. And if you could talk through that, are the sort of the highlights, and likewise the momentum from the Q1 to Q2 in terms of EBITDA, because you're up 80% sequentially.
Yeah, well, as to echo Ian, the fantastic performance of solutions and white label, which is lower margin business, but it is dropping cash to the bottom line. Both those businesses are working capital light. We get paid pretty much on the nail. Obviously, that helps. We have got very good risk management. So in relation to managing the margins that we have to place with our liquidity providers, we try and ensure that those are substantially less than the margins that we ask our clients to post up. And that bucket of money, both on the debit and credit, is not subject to safeguarding requirements. So we can effectively tap in and manage that working capital. We have outflows in relation to promoting the card business, which we're obviously very, very keen to do. And if either the MD of the card business or Ian says, "Oh, can I have a bit more money to fund it?" the answer is yes. My job is to make sure we can put it in there and get money available for investment projects, potential acquisitions if they arise. The marketing people want to do more events. There are things that the finance team can do to effectively free up more money and make it very, very efficient, work very closely with our banks. And I think, we're doing it very well. Also, I'd like to pay credit to the finance team to, get the numbers out so fast. It's terrific to get them out so quickly. I think it demonstrates to outsiders how in control we are of our KPIs. We look at them every single day. As you may read through the document, you'll pick up that, we have talked about some cost pressures. Everyone's got labour pressures. We've addressed that. We've got some loyalty programs in place, and we're seeing a significant reduction in the turnover of labour as a consequence of that. We massively invest in compliance, and we are very overt about the investments we're making in compliance as well. And the strength of doing that, of course, is that you can onboard clients faster.
And on that, just on the operating leverage, Richard, between sort of the Q1 and Q2, is that similar to what you've seen on a year-on-year basis? Is it correct for sort of like shareholders and investors to think about the operating leverage? Because, frankly, you're 80% up on EBITDA Q2 from Q1, largely because of your revenue, increasing, which is increased your contribution, and most of that's dropped through to your bottom line.
Yeah, well, also, we invested quite heavily in Q1 and not necessarily to the same extent in Q2. And, there is that operating leverage going through, but it is secular. And, do I expect Q3 and Q4 to have a similar pattern? I'm not sure. I think they will be closer in the direction of travel. You've seen the market estimates for this year.
Yeah.
We're not really going to change those. Unless we see, frankly, by mid-October that we are doing 6+ million months continually. But it's a very positive story.
Just going to say, certainly whets my my outlook. That's for sure. Now, just Ian, just on the sort of broader macro picture. Can you just talk through sort of like the inflation, sort of like, and I know it can cut both ways, but given inflation is in nominal terms, i.e. in pounds, sterlings and pence, and it's going up by sort of like, going up by double digits now, actually, in the UK. And obviously the transaction fees are on that nominal amount rather than the real, say, GDP, then can you just talk through that, and also with interest rates rising, because presumably you make income on cash holdings as well?
Yeah, well, okay, let's do that in turn. Yes, in theory, with inflation, then if we were doing £1 million transaction last year, it should be 1.1 million or whatever. This year, you can make that case very easily, and it holds a certain amount of water. Trouble is, inflation measures now are about baskets of goods, and the thing that's driving it is energy, and how much of that relates to the types of transactions we do, probably little, but then it could feed through to cost pressures within businesses that then drive up the value of a transaction, and round you go. Anything ultimately that shrinks economies isn't good. Because we might get bigger transactions, but there might be less businesses in business. And I think my answer to all of this is, that's outside of our control. But what's within our control is that we've assembled, over the last 3 years, the platform that we have, the connectivity that we have, the capabilities that we have, and the compliance capabilities that we have, and that even if the global economy takes a hit, there are lots and lots of businesses out there that could save lots of money by using what we do, And you can make an argument that there's be more appetite to be looking at that type of product in a difficult economic environment. So I don't have a binary answer for you, but what I do know is that what we have is utilizable by a vast array of corporates, way wider than the ones we've currently got on board. So there's a lot we can do. And I'd rather think that we will continue to grow strongly. It could just be without this stuff going on, we grow even stronger than that. But I think we focus on what we can do. We have a good pipeline of corporates that want to use the products that we have and the platform that we have. So I remain optimistic, but just cautious. You keep a weather eye on it. You know, who the hell knows?
And what about sterling volatility? Because obviously you deal with forex and international payment. I mean, because corporates are going to be hedging their positions, aren't they?
Yeah, the latter end of August and early part of September, we've seen, dollar go crazy. We're not too far from parity to the dollar on sterling, and sterling euro. Who knows? But there is parity, euro dollar or worse. So that shift has definitely helped shake some people out. And transactions get done that maybe they've been sat on. So yeah, we like a bit of volatility, but it'll spike the numbers today, but may depress them next week because people have done their business. So it tends to even itself out over the course of a year. And hence why we don't like monthly reporting to the market. It's good to do it in decent sized chunks so that you get a better feel. Because 1 week could move it one way or another. It's interesting actually when you look at the charts. The third week of August is always a quiet week in B2B. And I think that's another thing we should mention, that because we are way more B2B than we ever were, you would expect us to dip a bit in July, August. Most of Europe shuts down for August, and
you didn't do that. You didn't do that this year, though, did you? With revenues up 55% year on year.
Well, and hence my comment that I think we have enough demand, either that we know of or we will get, for what we're doing, that we can ride this out, whatever this is.
Okay.
Paul, I just mentioned it. You often seem interested in our travel business, and we have constantly reported that travel is the optionality in our portfolio. So it's actually quite pleasing to be able to report that the year-to-date travel business is up 75%, and in the Q3 it's up 133%. So that is optionality of revenue writ large.
And it's good margin, I think, as well, isn't it?
It is, yes.
Yeah. And then just, Richard, in terms of sort of like overseas, etc., given that the business is large or primarily UK corporate focused, is there a sort of like a longer term sort of like strategy to expand into places more so into, Europe and the US and maybe even elsewhere?
Well, if we can do that in a way that increases our EPS in the medium term, then of course we would look at that. But there's plenty of business to go for, in the UK and close to home. Ian has mentioned a number of times that we've got a toehold in the US. There are other geographies that we're looking at. We're certainly building up our connections with people, overseas. And should we either apply for a license or get access to a license, then we would want to use our platform to access those markets.
And then Ian, just in terms of, obviously Richard's building up a good cash mountain there. What are you planning? where are you planning to invest in that? Where you saw your key growth sort of levers, I guess? Well, obviously you've got existing, but as in on top of where you are currently.
Yeah, I mean, we're clearly back in the game for acquisitions if they present themselves and if they fit with our stated story, right? So, would we be buying international payments business that was largely B2C? Probably not. But, on the smaller end of the scale, would we, as we did before, buy international payments business, largely B2B, that maybe we're doing 1, 2, 3, 4, 5 million revenue a year? Yeah, of course, as long as they were sensibly priced and a willing seller. We're not desperate, but and would we look around for capabilities we don't have that we could build but would take time? So software capabilities, or maybe merchant acquiring businesses. That's that other side of the coin of what we're doing now. Yes. So I think the logical way to look at that is, I don't think the market gives us any credit for the cash that sits on the balance sheet. So we either use it to grow faster, or consider, dare I, use the D word, paying out a dividend at some point in time.
Yeah. And on that, Richard, you is the balance sheet being structured such that that's going to be presumably generating distributable reserves?
We do have some distributable reserves. We are doing some corporate restructuring to be able to upstream as much as we can, to at least give us the bandwidth to do a dividend, a share buyback to cover options, or anything similar.
Okay. And then, Ian, just in terms of big data, I did notice in the RNS, it talked about trying to, bringing out insights, etc. And it's an area that I know you're not an Amazon, but as in they use very well for their advertising in terms of helping their clients, tell them where spend is happening and where customers are, how they're actually spending their money.
Yeah, it's I think data in general. Maybe let's go back 3 or 4 years, pre Richard joining, and you can see that the financial reporting, the revenue reporting, everything is just night and day better than it was. But the one area of the business that we needed to invest in, you can't just click your fingers and fix it, is in the data side of things. So analysis. I'm always cautious with data, I have to say, because you can, to some extent, you can only analyze the customers you have, not the ones that you don't have. So you need to have that internal data analysis combined with good understanding of the macro environment or the addressable market, et cetera, so you can marry the two together and maybe target where you should go that you're not going, So building that data team up, which we've now done, and having the capabilities to be producing the KPIs that Richard referenced, so that we can manage people daily rather than, revenue is the kind of after everything end product, isn't it? Whereas ideally we want to have an idea now of what we ought to be making in 3, 6 months, a year's time. So we're at that point now that we are producing new data all the time, and it's starting to really help us guide our resources as to where we're going to get the best bang for the buck. So I think we will also give a bit more insight to investors about the customer side of that equation, which again relies on that data angle. I'm not saying necessarily we'll disclose CPAs and LTVs, or maybe we will, so we'll be guided a bit by investor appetite, but we have that stuff at our fingertips now, and we didn't a couple of years ago. And
just briefly, what is the competitive landscape like at the moment? Because obviously you're leading the pack. Yeah. Well,
yeah. What competition? Yeah. There's a slide in the presentation deck, which obviously we don't have here, where I we plotted where FairFX as was equals as is has gone from that kind of B2C card position to a more B2B platform position. And when you look, it's drawn in such a way that it tells the story you want it to tell, but it's gone from the more crowded areas into an area of all of our own. It is quite hard to compare us directly with anyone else. And so we see our niche as being defendable and hard to replicate, at least for a period of time. So I'm not looking over my shoulder at anyone in particular. There are So let's take corporate cards. You hear of Clio and Soldo and all these various fintechs that make no money and do one thing, and they aim to do one thing really, really well. And you can argue that they don't manage to do it in many cases. Or even, I don't know if you saw the news the other day, but Revolut, it was compared to them, do nothing like them. They're B2C dominated, and they have a plethora of compliance problems. It's been in the papers quite a lot recently, which we don't have, touch wood, because of our investment into compliance. So there's no one particularly that I would say compare us to them. Maybe in some ways the closest is Alpha FX, who reported yesterday, I think, and we're catching them.
Yeah, good. Okay, well, just finally, Richard, if you must be a reasonably sort of confident finance director, given your sort of start to Q3, etc. What's the sort of like the likely news flow for investors for the rest of the year then?
Well,
Trading
typically we would probably do a trading update early December. That usually coincides with the board approving the budget for the following year. So, that gives us sight internally and externally on any guidance or upgrading or updating guidance that we might give for 2023. We think it's premature to do anything for 2024. And we'd like to sort of reconfirm those sort of numbers in December and early January, and then hopefully come out with audited results about the 28th of March. So that's the likely cycle. And then typically we do an AGM statement and just pre-close interim, then the interim. I think it's just really important to give people line of sight and confidence in the numbers, where if you're comparing us to other companies in the market that may only do 4 announcements a year, shareholders are thirsty, particularly, on the private side of things.
Good. And I think that presupposes we'll have nothing else interesting to say.
Yeah.
In the interim, whereas maybe we will.
Okay, well, you've certainly whet my appetite again there. So really looking forward to it. Well done, gents, and please keep up the great work. And looking forward in seeing how the business progresses over the next sort of 6 to 12 months.
Thanks, Paul.
Thank you, Paul.